Welcome back to Stock School Daily.
Cantor Fitzgerald has reiterated their rating.
Reiterated, so they already held this position and they're doubling down.
Exactly. They're confirming an overweight rating for RZLV stock. That's a very strong signal. It shows they still have a ton of confidence in the company's direction.
And the number that everyone, zeroes in on, the price target. What is Cantor telling investors RZLV should be worth in, the next 12 months?
The target is being held firm at $8 per share.
$8. Now, that is the data point that really demands our attention. And to get the gravity of that, you have to put it in context. So for everyone listening, what was the stock actually trading at when this report came out?
Well, that's the key, isn't it? At the time the analysis was published, the stock was trading at just $3.64.
$3.64.
So this is the core tension of this entire deep dive. I mean, if you run those numbers, that $8 target implies a potential upside of nearly 120%.
Wow.
Specifically plus 119.8%. That is not, an incremental move. That is a fundamental re-rating of the company.
120% upside is... It's a spectacular claim. And that doesn't just happen because you're in a hot sector. It has to be built on something real.
So, okay, let's unpack this. What are the operational drivers that justify this kind of confidence?
Well, we can start with their recent history. Rezolve AI just delivered a really strong operational performance in December. And crucially, that strong end to the year came with some pretty positive forward guidance.
So management is signaling that they see this momentum picking up, not stalling out. Precisely. The analyst is basically betting on management's ability to forecast their own business accurately. It's not just celebrating past wins. It's about the trajectory they're setting.
Okay, so what are they doing internally right now to make sure the momentum sticks? How do they go from being a development company to a scaled revenue machine?
It's all about internal execution for them. Their primary focus is rapidly scaling its go-to-market team, or GTM team.
GTM, for anyone not totally swimming in startup jargon, that just means building out the whole sales and marketing engine, right?
Yes, the sales infrastructure, the marketing, the channel partners, everything you need to actually sell the product at scale and bring in revenue.
And that's connected to some recent hires, isn't it?
Exactly. This GTM scaling is the logical next step after a very deliberate wave of executive hires. They brought in the experienced leaders, and now they're building the teams for those leaders to actually execute their strategies. It's like having a great coach, but now you're finally building out the full team.
That makes a lot of sense. But, a lot of the time, the best sign of a good product isn't just landing new customers, it's how much you can grow with the ones you already have. Does the report say anything about that?
It absolutely does, and this is a major win for them. It really demonstrates the platform's maturity. The report highlights that the platform is becoming more fully built out, more integrated, and what that's doing is it's allowing for a much deeper penetration within their existing customer base.
Deeper penetration. So we're talking about clients who are already on board, finding more uses for the platform. They're expanding their subscriptions, maybe buying new modules.
That's it. It's that organic growth that shows the platform is actually solving real problems across different parts of a company. It's a huge sign of product market fit. And it means you're not totally reliant on that expensive process of always chasing new customers. The analyst is definitely factoring that in. Okay, so that sets the stage. Strong recent performance, good signs of organic growth. But, to bridge 120% valuation gap, that's not enough. You need a blueprint for the future. The source material talks about a very specific plan.
It does, a three-pronged growth strategy. And this is the explicit blueprint the analyst is using to justify that $8 target. It basically acknowledges that just selling more of what they have isn't going to get them there. They need accelerators.
All right, lay them out for us. What are the three prongs?
So the first prong is the foundation, net new logos. This is your traditional organic growth, just, winning new clients, expanding your customer base with the products you have right now.
Okay, standard stuff. What about the other two? I'm guessing this is where the high-octane fuel comes from.
You could say that. The second is accretive M&A. That's mergers and acquisitions. And the key word there is accretive. They're not just looking to buy revenue or competitors for the sake of it.
They're looking for deals that add value right away, right? Boosting earnings per share, bringing in high margin recurring revenue, basically buying growth faster than they could build it themselves. And then the third prong is all about leveraging networks, ISV partnerships.
ISV, independent software vendor.
Yep. They plan to partner with other software companies, integrating their platform into other systems. It expands their reach and their capabilities without having to build everything from scratch.
So if you look at that that triad, it seems like the whole story, the whole 120% upside, really hinges on the success of those last two. The inorganic levers, the M&A, and the partnerships.
Absolutely. The analyst isn't just valuing RZLV on what they sell today. They're valuing the potential that gets unlocked if, and it's a big if, they execute on those inorganic growth engines. M&A is a fast track, but it's famously difficult to get right.
Which brings us to a really important point. We have to transition to the counterbalance here. The risks, the caveats, what a more, conservative investor might be thinking.
An essential transition. No deep dive is complete without a healthy dose of skepticism. The analyst is optimistic, but they're not naive.
So let's start with the internal risks. What's the main execution risk that they flag?
The biggest risk is just the sheer speed and scale of what's required. The management targets for fiscal year 2026 are described in the report with one very specific word: lofty.
Lofty, that says it all.
It really does. It means achieving them will require basically flawless execution, especially on integrating those M&A deals. I mean, that's notoriously difficult, and Rezolve AI needs those deals to be adding value almost from day one.
And any experienced investor knows that M&A can just as easily become a black hole for cash and management's attention. What about external factors, things they can't control?
There are two huge ones. First, they are reliant on sustained macro momentum behind agentic AI.
Okay, hold on. Agentic AI, we hear that term a lot. Can you just quickly define it for us in this context?
Sure. So agentic AI refers to AI systems that can do more than just answer a question. They can actually plan, reason, and execute complex, multi-step tasks on their own without a human holding their hand at every step.
So an AI that can, say, summarize a meeting, draft the follow-up emails from it, and schedule the next meeting all by itself.
Exactly. RZLV plays in that very sophisticated niche. And for them to hit those lofty targets, companies have to keep wanting to spend big on that kind of tech. The enthusiasm has to stay high. The second external dependency, of course, is continued M&A activity.
Right. It comes back to the strategy.
It does. The analyst model assumes they can find and close good, accretive deals. But if market conditions change, if valuations spike, or if it gets harder to get financing, that inorganic growth engine just sputters out.
So if the analyst sees all these risks and calls the targets lofty, why stick with such a strong $8 target? What's the general market skepticism they're anticipating?
This is that classic tug of war between management's optimism and the market's pragmatism. The analyst expects most investors will take a, quote, measured approach.
Which in practice means they just don't believe the company's numbers?
It means they'll probably underwrite more conservative annual recurring revenue AR outlooks for 2026 than what management is officially projecting. The market is basically pricing in a miss. They're reserving judgment until they see cold, hard, quarterly proof.
And that's probably fair.
It is entirely fair. And that's why the analyst's position is so interesting. They're acknowledging the market is discounting the stock because of this risk. But they're betting that the potential upside is so huge that the overweight rating is still justified. The market is waiting for proof. The analyst is projecting success.
If you found this helpful, hit that like button and subscribe for more.